Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields. Kind of stuck in a range here. If you go back month to date, the range is about 11 basis points. Over the last, say, 5 to 6 days, has been about 10 basis points. And really, it's this 280 to 290 range, which the market is caught in, currently trading near the bottom of that range, that yield range, but still in that range nonetheless. And the market just seems to be kind of waiting for a catalyst moment, maybe waiting for sellers to run for the exit and buy back, maybe some disappointing news, or there's something out there that the market is not sure about and it doesn't have a positive spin to it. And I think that right now the bond market is telling you it's going to err on the side of caution. Hence, we are not seeing yields rise towards that 3% target, which is still a target for in the short term. However, it's just not as high a probability that we'll hit that until we get some help, probably from next week's FOMC. That's our next opportunity to get to 3%. And if you look at volatility remains elevated, but it's also trading in a kind of a flat range. So we traded volatility, just to give you an idea, in 10 years we traded up to 4.5%, then we traded back down to about 375. So you're seeing a pretty wide range of volatility. Now we're back up to about 4%. So again, we're elevated, but we're not really seeing any fear or excitement in the market. It's kind of one of those wait and see type of plays like we're seeing in yields. And I think the main reason for really why we're seeing what we're seeing in the Treasury market right now is the yield curve. The yield curve, recall as the Fed started to be a little more hawkish, we saw positive growth, GDP was going through the roof, we saw the yield curve start to steepen, something we hadn't seen in a long time. And now it's back to those decade lows that we had been talking about in late 2017. So right now, whether you're looking at 530s or 210s or whatever your choice may be, you're seeing the yield curve flatten with the back end outperforming. Now this is concerning because a flatter yield curve, obviously in a rate hike cycle, suggests much concern, whether it's about growth, whether it's about uncertainty. There's a lot of reasons. This used to be a Fed that was concerned about rising inflation too quickly. Now I think it's looking at growth as rising too slowly or not at all. Last GDP now that came out yesterday from the Atlanta Fed suggested that their expectations for GDP are about 1.9% for the first quarter. And that's down from about 5.5% about a month earlier. So a lot's changed. And the market right now is reflecting the uncertainty. We're seeing a flatter yield curve. We're seeing lower yields. We're seeing higher volatility. The trade of pain is lower yields right now, especially if the Fed is going to try and raise rates multiple times this year. Next week's FOMC is a slam dunk. But anything after that right now, to the common onlooker, is really uncertain. The market's pricing in 3 rate hikes in the course of 2018. However, let's wait and see it get through first and second quarter before we start to make that a slam dunk call. So right now the market's a little uneasy. We're seeing it reflected in Treasury yields, higher volatility. Next week's FOMC and press conference will be the decision maker, at least the market mover that we've been waiting for. That's not till next Wednesday. This is Todd Colvin coming to you from the floor of the CME Group.